you have questions, please ask in the chat, and our team in the background there, Spring and Hannah, will help bring the questions forward. Max and Al kind of swap off on monitoring the questions there that are moderated by Pat and Hannah and Spring. So, and then finally, of course, consult with your own tax professional and your own tax legal expert for your particular situation. We're only giving general information here today, and we don't represent your situation in particular. So today's conversation is specifically to get you ready for about a 10-minute conversation with your client. Now, you're a professional, you're the tax expert, and when your client comes to you, you need to be able to kind of present yourself in a professional way. And that's our goal today, is to give you enough information to survive a 10-minute conversation without compromising your reputation as an expert. So let's jump right into it. There's going to be two additional webinars where we go further into the taxation portion of how crypto is taxed, and then finally part 3, where we do an in-depth question and answer period and an overview of the more advanced crypto topics. So this will be primarily terminology and the basic technology of crypto today, and some kind of essential background information. We'll tease out a few of the tax issues and say, hey, these are the sorts of things that we'll dig into in future episodes, but we're not going to get too deep on particular tax stuff today. So heads up. So why now? Max, why now? I think you've probably seen the same thing we have, which is in the last 6 months or so, a massive uptick in activity here. What's been your experience?
Right. So a few moments ago, I was talking about how the IRS can now issue John Doe summons to certain exchanges as one means of gathering information about U.S. taxpayers and their potential tax reporting obligations with respect to crypto. But an even more obvious one is everyone's tax return this year, front page of the 1040. Everyone hopefully did their taxes or filed an extension, but on the tax return, or on the front page of the tax return this year, there's a question that says, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? It's an incredibly broad question that basically asks, have you ever breathed on crypto in any way? If yes, then check the box yes, putting the obligation on the taxpayer to come out and confirm whether or not they have. If you answer dishonestly on this question, it's treated almost as if you committed perjury. So the onus is on the taxpayer to answer yes to this question if it applies to them. Now, like many things in the law, while it seems like it can be like a pretty broad, simple question, there's actually an exception to this rule, which I believe we're going to talk about in the next webinar. But the IRS has come out and said that there is pretty much one circumstance where you could have acquired crypto, but don't have to check yes to this question. But the key takeaway here is that the IRS is gathering information on US taxpayers and their crypto activity, and this is one of the ways they're doing it.
You know, Max, I've heard people say that virtual currency could be practically anything. It could be gaming tokens. It could be anything that could eventually be turned back into cash again. Is that, I mean, it seems like virtual currency is even broader than just cryptocurrency. Is that true?
I mean, cryptocurrency generally, I mean, the way it started is that cryptocurrency is virtual currency, and it's sort of the underlying technology that makes it unique. Now, I mean, when it first came out, I don't think people were really contemplating gaming tokens, Fortnite bucks, or whatever they're called days. But I mean, when you think of cryptocurrency, you should think of it as virtual currency with some very complex underlying technology. The first crypto ever created was Bitcoin. And when it was created, it was contemplated that it would be a virtual currency. But the problem with virtual currency is what's called the double spending problem. How can we be sure that someone won't take the same virtual currency here and also spend it there, spend it in two places, spend the same virtual currency twice. You know, Jared, if I give you $5, you're pretty confident that I gave you $5 and I also didn't give the same $5 to Pat. And
Right.
you're pretty confident in that. You're holding it in your hands, but virtual currency, not so much. So cryptocurrency is using this underlying technology to solve this problem. Now, what is this underlying technology? It's probably a word that a lot of the people here have heard today. It's called blockchain. What is blockchain? Blockchain is really just a specific type of database. And what's unique about it is the way that it stores data. It stores data in blocks and it chains them together, and it is typically thought of chronologically. Now, what's special about that is that you have to meet a certain set of requirements to get validated, to get your information onto the chain. And so Bitcoin, for example, has a sophisticated network of computers that validates these transactions before it lets information get added to the chain. So going back to my double spending problem, if I were to try and spend the same virtual currency for a second time, that second time wouldn't get added to the chain. It would get rejected. And so that is what the relationship between blockchain, the word cryptocurrency, and, you know, and when people hear these terms, Bitcoin was the first one. It's what was contemplated with cryptocurrency. And now since then, there are, you know, hundreds, thousands, different types of cryptocurrencies using the blockchain as the underlying technology.
And I think what was interesting to me as I started getting into crypto a few years ago was just how different each of these coins really can be on kind of the underlying infrastructure. That everyone's coming up with a new way to do cryptocurrency, and a lot of them are done on different networks or transferred in different ways. And it really is, even for us that are in this every single day, it is impossible to be an expert in every field of cryptocurrency. And so a lot of it is kind of focus on Bitcoin, you know, keep your eye on Bitcoin, and that's kind of that, and that'll get you through most conversations. You know, Ethereum is another one that I'm sure we'll talk about too, that is worth watching, and those two kind of comprise the vast majority of what we think of when we say the term cryptocurrency. Is that accurate, Max?
Sure. Like I said, Bitcoin was the first cryptocurrency that attempted to be a virtual currency. Ethereum is its own separate project, its own separate blockchain. And the way people use Ethereum typically is to build decentralized apps on the blockchain, on the Ethereum blockchain, using Ethereum's underlying technology. A lot of tokens that people may have heard of, or the ones that are talking around, are actually tokens built on the Ethereum blockchain. They're often called ERC20 tokens. Kind of a misleading term because there's more than 20 ERC20 tokens.
People just call them all altcoins. It's just kind of alt. You know?
Yeah. Typically any crypto that's not Bitcoin is considered an altcoin, but Ethereum is so embedded in the crypto community that, you know, it is, you know, it's very important. But yeah, I mean, sure, I guess to answer your question, Bitcoin and Ethereum are the two prominent blockchain projects, you know, in the space so far.
Excellent.
Maybe Dogecoin. I don't know. Ask Elon.
So we talked about how this digital currency was meant to be used like money. It spends, right? And the technology keeps you from being able to spend the same $5 twice. But when it comes to taxes, a lot of times, usually, cryptocurrency is taxed like property, similar to the way that stocks are taxed. And so, Max, walk us through, if you would, a little, how is crypto like stocks and how is crypto not like stocks, especially in terms of tax treatment?
Sure. So as you said, crypto is similar to stocks because it is often taxed like stocks. I know this is a little bit more webinar too, but the same principle applies, is that you buy it, the price goes up, you sell it when the price goes up, and you have capital gains. And that's when you're going to have some tax reporting to do. It's also similar to a stock, I suppose, because it's speculative. Crypto and stocks are both pegged to a USD value, and because of that, there will be fluctuations in the price. But it sort of starts and ends there, because unlike stocks, crypto can be used to purchase things. It can be used to purchase things, tangible items, pay people for services. You could pay the Gordon Law Group in crypto. We accept we accept crypto for our services. It could be anything. You could pay.
You would normally say, here, take half of a share of Facebook in exchange for a cup of coffee, right? Like it just doesn't translate.
Yeah. So another property of crypto is that it's fractional. You could have 0.00001 Bitcoin, but you're not going to have that amount of Facebook stock.
Right.
Yeah, just as you pointed out.
Well, another aspect I think that where I feel like stocks and cryptocurrency are pretty similar is that the way you get into cryptocurrency and out of cryptocurrency is typically through an exchange, which looks a lot like a brokerage on the outside, a stock brokerage on the outside, but on the inside operates fundamentally differently. So I think a lot of people feel like, oh yeah, I hop out of TD Ameritrade and I buy Facebook, or I hop onto Coinbase and I buy Bitcoin, and it feels similar. But I think that's kind of where the similarities end, especially where it comes to reporting requirements and what have you. It's kind of a fundamentally, it's the same and different,
Yeah, and that's a really good point, is that you can buy crypto on an exchange, similar to how you can buy stock on an exchange. But crypto also has a unique property in that you're really interested in ownership of the crypto. And when you buy crypto on an exchange, you don't have this true ownership of it, because if the exchange goes down, which has happened many times before, or several times before, then you lose that crypto. So something that's unique about crypto is that you can take it off of the exchange and move it to what's known as a wallet. A wallet is just a place where you store your crypto, where it is truly yours. And there are different types of wallets. There's hardware wallets, there's software wallets, but a wallet really is just a way to secure your crypto, where it is yours. It is almost like having $5 in your wallet. It's yours. No one's going to take that away from you. Hopefully it's yours. I think we're going to get into that maybe a little bit later, more about wallets, but yeah, I would say that's one key difference between crypto and stock.
And I think to set the stage for the future tax discussions, it's also helpful to know that people will often trade one form of crypto for another form of crypto. I mean, if I'm trying to trade Facebook stock for Microsoft stock, I sell my Facebook stock and get US dollars, and then I buy my Microsoft stock and using US dollars. And so everything comes back to fiat. It comes back to a government-backed currency, where in the crypto world, I can just say, hey, I'll trade my Bitcoin directly for Ethereum and trade my coin straight across without ever going out to a US dollar amount. And that starts creating problems with valuation, right? Where we start saying, hey, what was the US dollar value of that trade if there wasn't actually US dollars exchanging hands there? Am I characterizing that properly?
Right. And, I think, probably we'll talk all about that in webinar 2, but the way you characterized the exchange of stocks is exactly how crypto to crypto trades are treated. You said, if I trade my IBM stock for Facebook stock, what I'm really doing is selling my IBM stock for fiat, which is government issued currency, just US dollars, taking my US dollars and buying Facebook stock. I forgot which order I did, but selling one for cash, buying the other one. Now, when you trade Bitcoin for Ethereum or any one crypto for any other crypto, from a tax perspective, it is treated as if you sold the first one for US dollars and bought the second one. Even though what really happened was you just traded one for the other. Every time you dispose of a crypto, you trade one for the other. It is as if you sold it for cash. Whether or not you actually had realized that cash in your bank account, it is treated as if you sold it for cash. And so we'll cover that probably a ton in webinar 2, but that's a very key distinction for tax reporting too.
And I think that it's particularly a key distinction for us here at Zen Ledger, because that's a large part of what we do. As a tax professional, if I had to go out and establish a spot price in US dollars, I'd have to do a fair amount of market research to say what's the US dollar value of that trade at that moment. And of course, that's what we do here at Zen Ledger, is crunch all that information so that tax professionals don't have to go out and do all the spot price valuation themselves, which of course that's not fun, to be
Yeah,
honest.
a tax software like Zen Ledger aggregates all of that, because your tax obligation when you sell it is what's the fair market value at the time. And one of the goals of the crypto tax softwares would be to have that information aggregated for you.
So I think one of the biggest questions that I got asked in fact, my wife asked me this the first time I told her, hey, I'm getting into crypto. She just says, isn't that just fake money? And I get that question every time I do a webinar. Every time over dinner, people are like, what are you up to? And I'm like, well, I'm a real nerd, they're always asking me, isn't that just like monopoly money? Why does it have any value? It's all just fluff. It's all vaporware. And I don't think it is. I really don't. And so I kind of want to address really quickly why this is more than just fake money. And the first is that we all agree that it has value, or at least enough people agree that it has value, that at any moment I can take my US dollars and exchange it for Bitcoin. And at any moment I can take my Bitcoin and exchange it back for US dollars. There is enough of a market. We agree enough that it can be bought and sold, and that's enough to make it real. If enough people buy in and agree that it has value, it has value. It's kind of the Beanie Baby scenario, right? But beyond that, one of the biggest reasons why people jumped into crypto in the early days was this idea, this kind of grassroots movement of saying, hey, you know what? There are politicians in the back room someplace making decisions about printing more money, and that fundamentally affects the value of my money in my pocket. And all that's going on, and I can't see it. And I think to be even a little more on point here, how many times have I gone to Chase Bank or Wells Fargo and money has just gone out of my account? Sometimes it's my fault, right? Netflix, I'm always surprised by that. But how many times have I had an NSF charge or some sort of bank fee that I'm like, wait a minute, that's not legit. How did that happen, And so a lot of people felt like they weren't in control of their own money. Like the government was doing stuff. And even especially in less developed countries, Argentina and Venezuela have both, the governments themselves have gone and bought Bitcoin to help prop up the value of their own currency. And so this idea of democratizing money and making it transparent is fundamental to the value of Bitcoin and cryptocurrency in general. And what that means is that people who hold it are the people who control it. And we call that a DAO, which is kind of a governance system for when new currency is issued and kind of takes the place of the government's typical role of establishing monetary policy. And so that's one of the key things that the blockchain does, is helps kind of manage the governance of the coin and keep it from being radically inflated or radically deflated. And so that grassroots idea of we want to democratize money has had a fundamental effect on cryptocurrency. And that kind of comes down to this idea of trustless money. Now, in a marriage, if someone said you had a trustless marriage, that would probably be a bad thing, right? But when it comes to money, the idea of trustless is you don't have to trust that the bank is just going to do the right thing with your money. You don't have to trust that the bank isn't going to hit you with surprise fees. Instead, it's all transparent. And this is one of the keys to understanding how Bitcoin works, is that you can go on the blockchain and see every account and how much money is in each account. And you can see all the transactions. It would be like being able to go to, say, Chase Bank and see what the balance was in every account. You don't know who owns the account, but you can see all the transactions. And there are some exceptions to that, especially when it comes to exchanges, and we'll talk about that in a bit. But the idea is that Bitcoin was meant to make it both secure enough that nobody could steal it, but transparent enough that everybody could see what was going on at every moment. They could see when new money got printed. It was never a surprise when new Bitcoin gets issued. And then finally, the money supply chain. Money works the same way as everything else. It comes out of a factory, and then it gets passed on to a wholesaler and a distributor, and then it gets passed down to a retailer, and then it gets out to the public. And in this case, it goes from a central bank to a regional or a commercial or an industrial bank. Then it gets passed down to a retail bank, and then it gets lent out for a car loan. Every step along the way, someone is taking profit. There's fees along the way. And so one of the other ideas of establishing cryptocurrency was to cut out the middlemen. And so you'll see people do transactions of 10 or 30 million dollars worth of Bitcoin for a transaction fee of $3. And it'll take place in 10 or 20 minutes, as opposed to and sometimes it goes up to a few hours, but as opposed to waiting several days for ACH or waiting a day for a wire. I can't tell you how many times I've seen wires just disappear. And I'm not a big banker guy, I'm a small business guy. So Mark, anything you want to add there?
I think one important fact, for people, if the people in the chat here, people watching, know nothing about Bitcoin. First of all, I think you explained everything great. Just one thing I would add is that you mentioned printing money, about how the United States government is, they can print money. There's a central bank that controls our monetary system, whereas Bitcoin, or cryptocurrency generally, that is trustless. With respect to Bitcoin generally, and a lot of these things, there is a limited supply. Typically, there's a finite supply when the project is created about how much there will be. And Bitcoin, for example, there will only ever be 21 million Bitcoin, ever, period. No more, no less. There only will ever be 21 million Bitcoin. We're not there yet, because I think we'll talk about mining and how that process works. Whereas how many US dollars there will be, I don't know. They're ongoing, continuing to climb.
And that's going to create some real scarcity. In fact, it already has. When PayPal first announced, hey, we're getting into Bitcoin, they started buying up all the Bitcoin reserves they could get their hands on. And it caused a pretty big spike in the value of Bitcoin for a while there. And now we've kind of caught up and normalized a bit. But for a while there, they were actively buying as much Bitcoin as was being mined at the time. So let's jump into the different types of cryptocurrency. Go ahead, Max. Why don't you take it away?
I think we may have sort of hit this topic.
We covered a lot of this already, didn't we?
Right, but so I won't beat a dead horse here. But the first ever cryptocurrency was Bitcoin. This is sort of this has sort of been the standard. Oftentimes, prices of other cryptocurrencies are tied to the price action of Bitcoin. It was the first one. It's been the most dominant one in the space, and so, Bitcoin is the dominant crypto. Probably the next most dominant one is Ethereum, because it has enabled other projects to be built on its platform. We kind of talked about, there's ERC20 tokens. Those are things built on Ethereum, but there's also countless other altcoins. You had mentioned earlier that sort of the value of a coin is whatever we as a society have, assigned value to. There is one that's increased a lot in popularity, and it's called Dogecoin. And people laugh when they think of Dogecoin, because Dogecoin was literally a joke when it was made.
Japanese for dog? Isn't that what Doge means?
Yeah, I don't know. Some people say Dogecoin, some people say Doggy Coin. There's some. It started from like a meme on Reddit where there was this, kind of like goofy looking dog.
Yeah,
it was meant to be a
goofy looking dog on the slide, actually. With
there's billions of Dogecoin, or more than billions. It's like almost an unlimited supply of Dogecoin. And we just kind of talked about how there's only 21 million Bitcoin, and that increases the value of it. But people have decided Dogecoin is something that they want to assign value to. And so the price has gone up not infinitely, but a ton. It was fractions of a penny. Now it's 40 cents. It's being talked about by Elon Musk on SNL. No one ever would have thought about that, 7 years ago when it came out. So I mean, there's literally like an infinite number of coins. Anyone can create a cryptocurrency, which probably shouldn't do without exploring the legal aspects of it and what you expose yourself to when you
Call
do it.
Max first.
Yeah, call Gordon Law first. Also, we accept Dogecoin as payment now because enough people have decided that there's some value to it. But so we accept Dogecoin as payment. Another actual important one to talk about is stable coins. There are cryptocurrencies that are pegged to the US dollar. There can still be minor fluctuations in price, and people often use stable coins in trading because all other cryptocurrencies are incredibly volatile. So when they want to trade out of a position from an incredibly volatile coin to realize some profit, they'll trade into a stable coin. So stable coins are just, when you hear a stable coin, that just means a coin that is pegged to the US dollar. There are multiple types of stable coins. There's USDC, US dollar coin, USDT, US dollar tether, a few other prominent ones, but yeah, that's what we think of when we say a stable coin. So yeah, all different kinds of coins.
And they're pegged to other fiat currencies too, right? There might be a stable coin that's pegged to euros and a stable coin that's pegged to, I don't know, Canadian dollars or British sterling or something. But
likely, but I don't really know on that one. But
yeah, I think the way that I've seen stable coins used primarily is that they're a lot more transferable than dollars. If I'm transferring dollars between banks, I've got to contact my bank, I've got to wire it, I get a wiring fee, where I can stick something in stable coin in a USDT or USDC and have it in my crypto account, and I can quickly and easily transfer it between accounts and get my money where it needs to go without all the fees that are typically associated with on-ramping my money into an exchange or pulling my money out of an exchange into a bank account. And so a lot of times this is the way that you transfer US dollars around in the crypto world without incurring a lot of fees coming back and forth between real life banks. Does that match your experience, Mark or Max?
Right. Yeah. The fees are important too, but I think so. I definitely agree. And the thing that I would add is that it's the lack of volatility that's really important. If you had an agreement, hey, Jared, you're going to send me 1 Bitcoin. Well, the price of Bitcoin can plummet or increase, thousands of dollars in minutes.
Yeah.
So
yesterday it was literally 33,000. This morning it's 37,000.
Exactly, and that's a $4,000 swing.
$4,000 fluctuation.
There's been bigger swings. And so for you to be able to say, Max, I'm going to send you $30,000, you could send me 30,000 USDC, as opposed to saying I'm going to send you 1 Bitcoin, a very volatile asset.
Yeah. Tell me, it was explained to me this way once, and I think it's really valuable to understand. Bitcoin is kind of the analog for US dollars. It's meant to be kind of a medium of exchange to a certain extent, and also a store of value. Where Ethereum is kind of like an Internet of Things. If Bitcoin was the internet, Ethereum is kind of the Internet of Things, where you have smart contracts that talk to one another, automatically execute, kind of the way your devices at home can talk to one another. Your fridge can automatically order you more milk when your milk gets below a certain weight, or you can push a button and order more Tide. Actually, I think Amazon did away with that, but I thought it was useful. It's kind of this Internet of Things, and Ethereum kind of plays in that automatic executing contract space, where Bitcoin is a lot more like a traditional dollar. Is that fair?
I would say that when Bitcoin was created, it was contemplated that it would be more like a virtual currency. Now cryptocurrency as a whole is, by the IRS, said that in 2014 they said we're treating it as property,
not currency, right?
Right. So before that, for tax or by the IRS, but before that, when it was created, it was contemplated that it would act like currency, like you said, kind of like a dollar. But Ethereum, when it was created, isn't necessarily thought of as it would act like a currency. It can act, it certainly can act like a currency. Anything can act like a currency, but oftentimes people are using the underlying Ethereum blockchain to build applications on and use the Ethereum technology in that way.
So Ethereum is more of a network than it is than where Bitcoin is more of a, acts more like a currency. I think I mean, there's a lot of, yeah, a lot of ins and outs there, but I've been interested as I've gotten into the supply chain world that there's a lot of action around Ethereum because they like the idea of automatically executing smart contracts, and those are primarily built on the Ethereum network, I think. So, which means people have to use Ethereum as the transfer value, as the currency to execute those contracts. And so there's this kind of underlying technological value of these smart contracts that supports the use of Ethereum as the currency on that network. And it's kind of an interesting kind of value add to the scenario. Well, let's jump really quickly into blockchain technology here. I've found that it's usually easiest to teach someone about blockchain by relating it to DNA. And what's interesting about blockchain is that it really is made up of a chain of blocks. And a block is just a container of information. And that information is all the financial transactions that's taken place on a particular coin. So we'll call this the Bitcoin blockchain. And so one block will have all the transactions for a certain period of time, or up to a certain number of transactions, all stored into a single container. And that container is a block of information. And then we put a stamp on it. We put a name on it. We say, hey, this block is called Bob. Okay. And the very next block that we create, the first line of information is the name of the last block. So we're going to create a new block over here. This one's Lisa. And as Lisa gets filled up with information, the first line of information is Bob's name. And so then Lisa gets filled up, and we stamp the name Lisa on it, and we create the next block. And the next block is named Jill. And as Jill fills up with information, it gets full, and we stamp the name Jill on it. Well, those names are just random. I'm just picking up names. But in reality, on the blockchain, those aren't random names. The name itself is determined by the contents of the block. And so if anything changes inside that block of information, it's no longer called Bob. Now it's called Roberto or something, right? Now it's Ferdinand. And so if anything changes, then we know, wait a minute, this is bad DNA. We need to get rid of this. And so that's how we know if a block of information has been tampered with, because it'll no longer be named Bob or named Lisa or named Jill. And once that name changes, it breaks out of the chain. The chain no longer holds together because that name determines its connection to the next block. And so that's kind of a broken down, rudimentary version and oversimplification, frankly, of how blockchain works. That you have individual blocks full of information. That information determines the name of that block, and then the name of that block is the first entry in the next block, and that's what chains it all together. And so we call it basically unhackable. And part of the reason for that is that just like your body has a bunch of copies of the DNA, a network of computers that maintain the blockchain all have copies of the DNA as well. They all have copies of the blockchain. And so they'll constantly be checking with each other. Hey, does mine still match yours? Does mine still match yours? Does mine still match yours? And then if something goes wrong, they say, wait a minute, yours doesn't match this guy and this guy, so let's just chuck yours out. And they delete it, and they copy over it, and they move on with life, just like your body does. Now, your body chucks out bad DNA, makes another copy, and moves on. And so that's why they call it unhackable. Another word that you'll hear is deterministic. And what that means basically is that the information is what determines the name. And so the characteristic of being deterministic is a lot of what adds the real security value on the blockchain. And then a final, well, let's just leave it at that. That's good, I think. Max, walk us through here. These are the different kinds of crypto transactions that we see, whether it's Bitcoin or Ethereum. Walk us through real quick, because each one of these has a dramatically different tax situation, right?
Yes, certainly. And these types of transactions all have a different tax implication that I, again, will cover in great detail in webinar 2. But one way to acquire crypto is to buy with fiat. And again, what is fiat? Fiat is just government issued currency. It is just US dollars, the euro, whatever it is. Fiat is government issued currency. You can use government issued currency to buy crypto. Now, as a practical matter, what does that look like? Typically, you sign up for an exchange. One of the most popular ones in the United States is Coinbase. They were the first crypto exchange to just go public with an IPO. You can connect your bank account to Coinbase, use funds from your bank account to buy crypto with fiat. That's it. You can buy crypto with fiat. You can also sell your crypto back for fiat. Another way is you can, so let's say you've taken your fiat and bought Bitcoin. You can take your Bitcoin or any other crypto and trade that for others, typically on an exchange. So this can happen on an exchange. It can also happen what's called on a decentralized exchange, which is more of just a peer-to-peer type of transaction. You can use crypto to send and receive payment, such as for Gordon Law Group. You can use crypto to make donations and gifts. You know, I could gift Jared some crypto. I could make a charitable donation.
I'm ready.
Yeah, and one of the things we'll talk about in the next webinar too is the donation of crypto to a 501c3 charitable organization and the tax benefits that you can garner from that. You can also, people get paid in crypto. There was a story recently it was that an NFL player was going to be paid in Bitcoin. It was actually a little bit misleading because really he was just going to be getting paid and then buying Bitcoin. But he's a big believer in everything that we've talked about here today. And so, but bottom line is you can pay people in crypto. A lot of crypto startups that are creating their own token will pay employees in their token or pay contractors in their token. But there are all different types of ways to deal with crypto. And then all of these are going to have their own unique tax implication, all of which Zenledger can handle as well.
So I think part of understanding how this all works, frankly, the hardest part of doing taxes, and we're coming up on about 15 minutes left here. The hardest part of doing the taxes in this whole thing is gathering all the transactions, because people will typically have several wallets, several exchanges. They might have a cold wallet and a variety of different ways that they're holding their crypto. And each of those transactions and each coin has its own blockchain. And so it's an enormous amount of information to gather together into one place. And that's honestly the hardest part. Once you have all the information, you know, then you have to go about crunching it all and figuring out your tax basis on each coin and the holding period on each coin. And is it long-term? Is it short-term capital gains? Was this income, you know, from, you know, was this payroll income or was this interest income? And so it gets really hairy fast. But a lot of it kind of boils down to these three scenarios. Where do these transactions take place? Well, if I've pulled my money off the exchange and I'm holding it myself, that's kind of like going to the bank and pulling out cash. You know, it's kind of like saying, hey, I'm going to put my cash under my mattress. I'm going to put it in my own wallet because, you know, I know what happens to money that goes in my wallet. I don't know what happens when the bank's holding on to it. And honestly, that's kind of the feeling in crypto. They say, hey, in the exchange is holding your money for you, and they hold your keys for you. They say, you know, if it's not your keys, it's not your crypto. And on an exchange, they have custody of your money. And so there's this real fundamental core belief system that a lot of crypto enthusiasts or crypto purists have, which is basically exchanges are a necessary evil, but as soon as you buy your crypto, pull it off and put it in your own wallet. Well, wallets pull the information directly from the blockchain. And so just with a wallet address, we can go on to the blockchain, pull all the information off, all the transactions that happened within that wallet, and it's transparent, it's public information. Just like your home address is public information. What you don't give people is the key to the front door. Your home address would be like your public key. The key to your front door, to unlock it and get stuff out of your house, that would be your private key. And so wallets will have a public key and a private key, and wallets will basically be an address for a wallet will tie out to the blockchain, and then software like Zenledger can pull all those transactions off and calculate the tax implications rather quickly. Exchanges hold the money for their clients, and so it's basically all held in one pool. So it doesn't have the transparency that the blockchain affords. And so the exchanges, we're at their mercy, which means as tax professionals, we have to go on and pull the information off the exchange, or the client has to pull the information off the exchange. We just kind of have to trust what they've given us. And that information comes in all sorts of shapes and sizes. Every exchange kind of has its own CSV format. Some of it will export in one kind of encoding, and some will export in another encoding. I ran into one last week that came out with a lot of Chinese characters embedded with all the data, and I had to go through and manually pull them all out. I mean, that wasn't easy. And so as you're working with your clients, it's important that you talk to them. I need all your wallets. I need all of your exchange information. And that will be the largest portion of preparing the crypto taxes, is working with the clients and gathering all that information. Important to know the top three exchanges by name. So you should know the name Coinbase. You should know the name Kraken, and you should know the name Binance. And Binance has both Binance US and Binance the rest of the world, Binance Global. And recently, Binance Global cut out all United States accounts and just flat out refused to give anybody access to their transactions. And that was what, 3 days before tax day, Max?
Yeah, I mean, I've been hearing it a lot from clients.
Yeah, so that's something to be aware of, that you're completely at the mercy of the exchanges as far as that information, and oftentimes we find bugs in the information. Now, mining is a lot like this. Max, do you want to cover mining, or do you want me to cover it? I think I stole your last slide. I'm sorry.
Yeah, I think. Why don't you go ahead?
Okay. So mining is really the way that new coins, especially when it comes to Bitcoin, that new coins are minted. So when money is issued, when new Bitcoin comes out, it's because computers have been doing all this work. So earlier we talked about how the computers are checking with each other. Hey, does your blockchain still match my blockchain? And that kind of maintenance level activity is constant low level work. And a lot of people will just set up their computer at home to just be doing this in the background. And they make a little bit of money from it. And just those maintenance things, if they're not even trying to go out and grab the newest Bitcoin, they're just kind of helping maintain the network. And they actually get paid for that. They'll get little tiny pieces of Bitcoin called Satoshis. And it's kind of like a penny is to a dollar, except it goes out 8 decimal places instead of 2. But as far as taxes are concerned, that's considered other income. It is actually taxable income. And so that's something to be aware of. Now, if I'm hoping to win big, right? If I'm hoping to win big, then I'm trying to go out and I'm doing these extra math problems. And if I'm the first one to get the answer right, and I get it checked with the teacher, and the teacher says, yeah, it's right, then I get the next Bitcoin. Now, I'm the lucky winner. And so it's in some ways, it's almost random who gets the next Bitcoin that comes out. And so people set up these mining operations to try to grab the next new Bitcoin that gets issued. Now, it's not really fair because it's not really random, right? It's all based on computing power. And so what we've seen recently are governments and large corporations over the last few years creating these large mining operations to mine the more valuable coins. And that, of course, squeezes out the little guys. And then the little guys move over to altcoins. And so a lot of times, if you're doing tax returns from say 2015, 2016, 2017, you might see individual investors involved in Bitcoin mining, where 2018, 2019, 2020, you're going to see them mining more obscure coins and probably a lot of obscure coins to make up for the fact that they just can't compete with, the Chinese government or the Russian government when it comes to computing power. There you go. I think, Max, what did I miss there?
I think you hit it all. I thought at one point, did you say that mining is considered other income? Again, probably more webinar too, but oftentimes.
Yeah, that was my understanding. You're the pro here. You tell me. But I thought that if I got a few satoshis for just doing the maintenance level activity and that gets deposited into my account, that comes in and acts as other income.
Typically, crypto earned from mining is considered Schedule C type income. It's like as if you're operating a business. And
Gotcha.
So your associated expenses operate as deductions from the revenue, which is the acquisition of the Bitcoin for mining.
Yeah, I think there's a real advisory opportunity there too, isn't it? That you've got people that are just kind of doing it as a hobby, when really they ought to form an LLC and take advantage of kind of Schedule C kind of deductions there, rather than just hobby deductions. Is that
right?
Correct?
Well, you can have Schedule C obligations whether or not you're an LLC. You could just be a sole proprietor. You could just have a lemonade stand out in front of your house, and that's your business, and that's your Schedule C. I mean, you don't necessarily need to have an LLC to have Schedule C tax reporting obligations.
No, great, good point, great point. Thank you. Are we ready to move on to staking?
Sure. Yeah.
Okay. So staking is a lot like, let's say, certified deposits in some ways. If I go to the bank and I say, you can hold on to my money for 6 months, the bank agrees to give you a preferred rate on your savings because you've said, I'm not going to pull it out in the next 6 months. And in a lot of ways, that's kind of the biggest form that staking has taken on at this stage of the game. It's called DeFi, or decentralized finance. And in that way, you kind of earn income that's similar to interest income that's coming in off of agreeing to let someone else hold on to your Bitcoin for you for a while, and then you're earning interest essentially on that, and they call that staking. A lot of times, there's also other sorts of rewards attached to it. So, for instance, Crypto.com has a debit card where they'll offer as much as 4% cash back if you have a certain amount staked on their platform. And so not only are you earning a little bit of interest for staking it, but on top of that, or the growth of the coin that you staked it in, but on top of that, you're earning 2 or 3 or 4% cash back for every time you use your debit card, based on how much you have staked. And so they have these kind of complicated, not too complicated, but relatively complicated reward systems set up that often translate into pretty substantial gains. A 4% cash back on a credit card would be amazing, right? But then on top of that, you're also gaining other rewards, often for staking as well. Max, why don't you fill in some blanks there for me?
Sure. So, like, you first talked about mining, right? And all this machinery and network power that is used to validate transactions and to try and add blocks to the chain. That's called proof of work. And it takes a lot of energy. And so maybe in the news, you've seen people talking about Elon Musk again, talking about how it doesn't like Bitcoin because it uses too much energy. It's bad for the environment. Proof of work mining uses a lot of energy, or mining is typically thought of as proof of work. Staking, or is called proof of stake. This is where, instead of using machinery to validate these transactions and add to the chain, you can validate transactions by taking your crypto and holding it in a certain place. And that's kind of sounded like your certificate of deposit example, where you're holding it in a certain place. That is helping the network validate transactions, add blocks to the chain. And in doing so, it is rewarding the people who have staked their crypto with small amounts of it. This is considered much more energy efficient. When Ethereum was first created, it came out using the proof of work concept because the proof of stake didn't really exist yet, but it was always thought of that they would shift towards proof of stake. Just recently, we saw that Ethereum is shifting towards proof of stake, or trying to, and right now you can stake your Ethereum. There's some different requirements that you have to meet for Ethereum. Usually you have to have 32 of them, which right now is a lot of money. And you can't access it for about 2 years or so. Now, DeFi is a little bit different. So we had mining, which is proof of work. We had staking, which is proof of stake. DeFi sort of tries to take banking concepts, but take out the bank. It tries to be decentralized. It doesn't need the bank. It is more peer-to-peer. So on a DeFi platform, people could aggregate their crypto and people could take out loans in crypto without having to go through the bank. And, if you've ever taken out a loan, it stinks. It's not fun to go through a bank to take out a loan. And so these DeFi platforms will allow people to aggregate their crypto to do things that you do in traditional finance, but in a more decentralized peer-to-peer way. Now, while you could take out loans, that also denotes that people are lending their crypto and earning interest on it. So that is generally what's thought of when, DeFi is sort of its whole new world. There's a lot of things. There's more and more DeFi projects every single day, but that's kind of generally how I would characterize DeFi. It's banking without the bank, which, is huge these days. There are people who are unbanked, and so, but maybe they have some crypto, and maybe this enables them to, access, traditional finance things such as loans that they otherwise wouldn't be able to.
I think one of the things that becomes especially interesting as a tax professional is with the fluctuation of crypto. You might end up having no crypto, or your crypto has very little value, but you end up with a large tax bill, depending on your reporting period. And knowing about DeFi and knowing that they can stake their Bitcoin and receive a loan is one way that they can hang on to their Bitcoin and still pay their tax bill. And so there's an advisory opportunity there as well to really, if you understand how it works, you can actually help your clients pay their taxes, get a loan and pay their taxes.
Sure. Yeah, people can, a DeFi platform, you can collateralize your crypto to take out a loan. And it's just like any other loan where you have collateral. If you default on the loan, you lose your collateral.
Lose your collateral, exactly. So I think as we wrap up here, I think one of the key points that we touched on a little earlier is that it becomes extremely difficult to pull all these different sources. You got your DeFi, you got your staking, you got the capital gains and capital losses. You have wallets, you have exchanges. You can actually do just straight on-chain transactions if you're a big enough nerd. If you're a Linux guy, then you might be trading on your own. But long story short, the important thing is being able to sync all that data together. And part of the problem that we've seen in recent years is that the IRS has sent enforcement action letters out, usually in batches of 10,000 at a time, and with wild estimates of what's actually owed. And it becomes largely based on information that they've pulled from exchanges. The problem is that an exchange can't see what's going on in another exchange, and they can't see what's going on in your wallet. And so if I move my own money from Coinbase to Kraken to Binance and then into my own wallet, it starts each one of those. If I'm just on the other side of the transaction, each one of those starts looking like a taxable event. When really all I've done is moved my own money from one of my own accounts into another of my own accounts, not taxable. And so one of the key things that ZenLedger does is pull all those transactions together and prove what the value was at the time of the transaction, what the holding period was, what the cost basis is, and follows it right from inception all the way through to the current position, and says, hey, it's not a $150,000 tax bill. One of my good friends, Scott, it looked like he had a $150,000 tax bill, and then by the time we crunched everything, it came out he actually only owed $7,500. And it's because of that transferring those self transfers between his own accounts. And as an accountant, that is the last thing I want to be doing, is looking at 25 different CSV spreadsheets and trying to aggregate all this data and make sense of it. And so that's really where Zenledger comes in, is creating uniform data and a uniform central repository of information where it's all been standardized and then analyzed for tax liability. Now, we interface with tax professionals on a few different levels. Typically, a tax professional will still maintain the relationship with the client, and then we take a supportive role as we help the clients bring in the information, and you help your clients gather all the information. Most of that is put back on the client. They're the ones with the login, the password. They're the ones with the keys, and so usually they're hesitant to hand over their passwords to their tax professional for good reason. But the long and the short of it is, that's typically what it looks like. The client is gathering information into their Zenledger account, and then you, as a tax professional, have access to that Zenledger account as well. And then in the end, they hit the calculate button, and it spits out the 8949s and the Schedule Cs and all that kind of stuff that you're going to need in order to actually file. Now, in some cases, we act as the back office, where firms are going out and actually actively soliciting, hey, if you have crypto, come to our office. We're good at handling it. And oftentimes that is a pretty heavy lift to gather and crunch all that data. And so we'll also act as the back office in the sense of helping support your staff in putting these things together. We're also comfortable working directly with your clients if that's what you prefer. Now, we also have a full service option where essentially clients can say, holy smokes, this is too much, or tax professionals can say, crypto filings, I don't want anything to do with it. I'm just going to refer it over. And that's actually where Gordon Law Group comes in. And Max, why don't I pass that off to you, and you can correct me where I've misspoken.
Sure. No, you hit it on the head. I mean, Zenledger is generally a DIY software. It's designed to be able to do it yourself, but it can get complicated. And so if you want to outsource that to someone, Zenledger's full service package means that you get to work with us to help you navigate reconciling your crypto history, whether it's just the current tax year or whether that's starting from the beginning if you haven't filed tax and working through to the present. Yeah. So yeah.
There we have it. I know it's a whirlwind. It's a lot to take in. We could probably talk for another 2 hours, especially if you got us geeking out on certain subjects, I'm sure. But we want to invite you all back to the next section where we dig in deeper on the taxation. So much of taxation situation comes from how the crypto is actually being used. And you really can't understand how it's being used without understanding the culture around cryptocurrency and the technology of cryptocurrency. Now that you have that foundation, and we'll send out a recording of this to all the participants so you can go back and review if you choose to. But now that you have that foundation, the next step is to get into the tax consequences of how the technology is used and how it's being held, how the cryptocurrency was earned or purchased, and what that means. And then following up to that, we'll have an in-depth question and answer period with Max and Pat Larson, the CEO of Zenledger, really getting in deep on the more advanced topics, things like tumblers, things like liquidity pools, NFTs, all that awesome weirdness. So it kind of gives you an idea of what's to come. Check your email box. I'm sure you'll see a few emails from us. One will be a poll asking how we did and if we covered the right information for the right length of time today. Please, we really appreciate your feedback there. Max, anything you want to add before we sign off here?
No, I just want to reiterate that, we are the full service tax preparer, but we also do, other tax services for people, offshore taxes and disclosures, sales tax compliance, audits, tax resolution. We do a lot of crypto tax, but we do a lot of other tax problems too. So anything that anyone watching may need help with, we are available to help.
Awesome. Thank you so much. We sure appreciate your time. I'll stick around for a bit if there's any burning questions. Feel free to send them over. But you've got the contact information here. The questions that we didn't get to today, we'll reply to by email, and of course you're always welcome to reach out to us directly, and we're happy to help. If you have really complicated tax questions, I think Max is your guy. If you're wondering how your tax firm can get set up to do this on an ongoing basis, best practices for working with anywhere from half a dozen to several hundred clients with crypto filings, please give me a call and or shoot me a text or an email, and we'll jam. We'll get together and figure it out. I think either of us are happy to do trainings for your specific firm as well. I think we're both really comfortable doing continuing learning credits and what have you. So by all means, anything we can help with, we're here, and pretty flexible. Well, I mean, I'm like 41, so I'm not as flexible as I used to be. So take it for what it's worth. All right, thanks everybody. Sure appreciate your time.